What's up, Outliers? Happy Friday. Today, for our basics session, we're going to talk a little bit about risk and reward. This conversation is generally beat to death. There's a lot of great information out there on it, so I actually don't anticipate this being a extremely long and in-depth session, but there are a few things that I think we need to talk about. And I want to start, as usual, by setting the landscape. And I want to talk about some of the things that you likely have heard or that you might currently think are good ways to go about managing risk and so on. So I'm just grabbing a blank space for us to start our discussion. Okay. Risk and reward are two sides of the same coin. We already know in order to get some kind of reward, you need to put up some kind of risk. One of the first common misconceptions between these is that they are purely correlated, and they are not. They're generally correlated. In general, if you take more risk, you can achieve greater reward, but it is not linear. And it does not mean that if I take 5 units of risk and instead I take 6 units of risk, that I'm going to get 1 more unit of reward. It's not how it works at all. The reason why that non-linear relationship is important to keep in mind, and in your mind, you should view risk and reward correlated, but not purely so. The reason why that's an important concept is because it will shape the way that we approach markets and the way that we think about things. So that's the first thing we need to level set on. The next thing, let's talk about some bad advice that you probably have heard. And if you have bad advice that you've heard, throw it in the comments. I literally might not get them all, but I'll list some and see what you guys say, and we'll piece them all together. One of them is for sure, don't be greedy. This is not good. Another one is wait / give it more time. This is bad risk reward advice. Next bad risk reward advice is take profits quickly. Another one is dollar cost average into a loser to reduce your basis. Next one is roll your options. And so on. Tons of different versions of these. We'll go through some of them quickly, but I think you're actually going to detect some of the common themes pretty quickly as we go through these. So when we think about striking this balance between risk and reward, let's start with an ideal scenario. Ideal scenario is we can maximize our reward potential and minimize our risk potential. Both of these this would be optimal. We would all like this to be true. If you could stand to get a bigger reward while taking less risk, everybody would do that. That leads to what we know as competitive environments, because your perception of reward and my perception of reward will be different. Your perception of risk and my perception of risk will be different. This is what leads to the competitive marketplace that is markets. There are people that will say, as this stock is going down, and once it hits maybe this point, this person says, well, I like the upside potential compared to the risk, so I'm going to buy it here. And then maybe somebody else says it here. The point that I'm making is that people have different responses to both of these inputs, and it's quite relative to the individual. You have to think through this pretty carefully. In order to develop a healthy relationship with risk and reward in general, you have to assess your own tolerance. This is the shit that nobody tells you that you need to do. But I guarantee you, if you don't do it, you're going to have busted trading and busted management because you cannot make good decisions without some sort of reconciliation around these from the onset of your trading. From the reward side, the question we should ask ourselves is not, what's the most reward that I want? Obviously, we want it to be as great as humanly possible. The question on the reward side is, what's the lowest reward that is worth my time, effort, energy, the additional risk? What reward is worth me doing this? And then the risk side of the equation is the inverse. What's the most risk I'm willing to take to get here? Here's an example. A lot of times people will say something like, well, if I'm going to trade, I need to beat the market to make it worth my time. Insanely ignorant statement, but people will say that. So let's say that the market averages somewhere between 8 and 14% a year. It's a big range because most recently it's been on the high end, but longer term averages is, anywhere like 8 to 10, something like that. So let's say that the market average here, we'll just call it 10% for the market. And let's say that you're surplus over the market. In order for this to be quote unquote worth your while, you want at least 25%. Then the next question we have to ask ourselves is, okay, well, what kind of risk are we comfortable taking to attempt to get to this 25%? And some people, as they look at their portfolio, they're like, well, I really don't want more than like a 30% drawdown to get there. And we arrive at our very first incongruency. Because if you look at the average market return of 10%, and you look at the MDD, which is the max drawdown, the path that the market takes in order to get this over time, the market can easily experience declines of 40 to 60%. 60 is a little deep if we're keeping up for real. 40 is really deep for the market itself, but it can easily be somewhere in this range. What's the problem? Well, the problem is our mandate is we need to do 2.5 times what the market does, and we're expected to do it with 70% of the total downside vol, 75%. That doesn't make fucking sense. You're weighing both sides of this right out of the gate. You're effectively saying, I need to do way better on the upside potential in total, and I'm going to have better downside. Now, I want to be abundantly clear. There is absolutely nothing wrong with developing goals like this as you develop as a trader. But remember, this stream is for beginners. As a beginner trader, you have essentially no say in what reward you want. If you've been trading for less than 5 years and you have no true track record, meaning in terms of detailed trade logs that give you performance by strategy to determine what's doing what, if you don't have those details in order to make any sort of objective analysis, you do not get to have a reward target. Your reward target, if I had my say, is greater than 0. That's all you get. If the market returns 30% and you walk out up 1%, you did fine. That's the target in the beginning. Now that goes into a whole other psychological discussion about aiming low enough. That's another bag for another day. But what I'm highlighting here is that at the onset, for a lot of people, they have a completely busted foundation when we approach this problem. We're saying, I need to more than double the market to the upside with less risk, and I have no experience. How fucking well do you think that's going to work? Probably not that well. And this is exactly why then when you add on really bad advice that you've heard, it leads to people making terrible risk-reward decisions. Now, as part of that self-analysis in terms of risk and reward, there's something that I put up on the Patreon a while ago, and it's called a money mindset exercise. It's not directly risk and reward, but it's proximal. And that was something that I built. I told you guys this before. I built it for myself to try and better understand like what I think is realistic, what I value, and shit like that. part of the baked in element of that kind of exercise is measuring what reward is worth the risk. So let's do a quick game. And there's different ways you can play this game. So let's try an easy version first, and then we'll try a slightly more aggressive version. Remember the context that we're playing, risk and reward. Okay, let's start with, there's a coin flip or a going flip. If it's heads, you have a 50% probability of making $1 million. If it's tails, you have that 50% probability of getting, if it's tails, you have a 50% probability of losing 250K. Think of where you are right now in life. And if you would flip the coin, if you flip this coin, you can make $1 million, or you have to pay 250 grand. Which do you do? Do you flip or do you not flip? Throw it in the comments or the chat. Hey, yo, what's up, Joe, Lauren, Christian, Black Mamba? Great to see you all. What say you? Flip or no flip? Do we want to flip this coin or not? What do you guys think? Christian says not flipping. What else we got? Okay, so I see no, no. Okay. Let's reconfigure then. Let's go to another layer. Can make 1 million, or you lose 100K. Have to pay 100K. Who flips this coin? Flip or no flip? Deal or no deal? Do we flip the coin? So it looks like for Christian, we're getting closer. That coin gets flipped. Okay, so we have one that's flipping. Two that's flipping. Three that's flipping. Okay, let's do another layer. 1 million. 150K if you lose. Flip or no flip? This means if you get heads, you get 1 million. If you lose, you have to pay 150,000. Lauren says flip. Oh no, Lauren doesn't say flip. I don't know what Lauren says. I don't know if that was for the one before this one. Okay, so I see one that says flip. Anybody else flipping? Okay. 2 flips. And still flip. Okay. So now one more iteration. Heads, 1 million. Tails, you pay 200K. Last one. Who's flipping? It's a single flip. Not flipping, okay? So for Christian, we've identified so far what the value is for them. The funny thing is, if we look at all of these, you still are positively expectant in a vacuum. But what I'm highlighting here is that different people have different values and different levels of risk that they're willing to tolerate, because there's the ability to lose. Now, one other version. I'm just gonna, it's gonna take me. One other version really quick. Similar premise. Slightly different. Heads, you get $1 million. Tails, you get nothing. If you don't flip, you get $50K. Flip or no flip. If you do not flip, you get $50K no matter what. If you flip, chance of $1 million or chance of nothing. Okay. Emmett says flip. Well, it's one that's going to flip it. Lauren says don't flip. Another one says flip. Another flipper. Oh, one moved from flip to don't flip. Okay. Last version. Same question. Heads, 1 million. Tails, nothing. Don't flip, 200K. Last one. Flip or no flip? No flipping, no flipping. Okay. Another don't flip. Let's talk about the risk to reward profile here. When we look at this scenario where we effectively have no money at risk of our own, yet we do have money at risk that otherwise we would have. Guess what this is? This is an open trade. You have the ability to realize a P&L and take your P&L down, or you have the scenario where your trade could be worth way more, or it could be worth nothing. Now, the most important part of this kind of exercise is paying attention to your sensitivity to different numbers. Because there were two people that would take the 50K. Why would they take the 50K? The reason why they would take the 50K is because they're at a financial point in their lives where this 50K makes a material difference up front and is worth them foregoing an opportunity at this money. There are other people where that 50K is less impactful at this point, and it's worth wagering this for this potential profit, even though they might walk away with nothing. This is exactly why the concept of risk reward is so nuanced and so delicate. Because as we get down here, you can see that there's quite a few people that would say, I'm not going to flip it. And the funny thing is as you meet more people that have more money, they would 100% flip this coin. Because the marginal difference that the 200K would give them is nice, it's fine, but it's not going to make a material difference in their day-to-day whatsoever. And this would be cool because you can go buy maybe a Ferrari and something else. Your risk to reward tolerance is super duper individualized. Insanely so. You have to understand yourself a little bit. The reason why I'm going through this and trying to give you some different lenses to look at this at, because the way that you build strategies depends a lot on your natural tendencies. The reason why it depends a lot on your natural tendencies is, let's say that you're the kind of person where if you win a lot, you're more consistent, you're more excited to do the work, and you like that gratification. It's good, positive feedback. It can make sense for that individual to make the suboptimal decision of trading high win rate strategies versus some other trend following strategy that might have a low win rate but really high expected return. And it's because that person we just talked about, they have this innate part of themselves that prefers that other risk reward profile. If we attempt to get that trader instead to embrace a lower win rate, higher average win strategy, they might be able to make the jump, or they might completely blow the fuck up. This is exactly why this advice, this stream of advice, means literally nothing. It means nothing. Because there are some strategies where the only way that they're profitable is you have to be greedy when it's time to be greedy. Because if you don't do that, low probability of winning, if you don't do a good job riding each profit for as much as you possibly can, you will likely walk out with something that doesn't make money. You have to be greedy in that kind of thing. The idea of waiting and giving something more time, that's indecisiveness. That's not, oh, maybe something will come back and that's my thesis. That's just don't make a decision because otherwise it sucks to realize a P&L. All of these are bad pieces of advice. The most important factor first to walk away from this session with is your risk to reward tolerance is very personal, and you have to understand what it is. And you can take that magnified version of what we just did and scale it down. So if we attach different probabilities, let's say that there is a 70% chance that you'll make $20, and then there's a 30% chance that you'll lose $80. This is selling a vertical spread. And the way that you think about these numbers and the way that you react to these numbers will tell you a lot about the kinds of things that may or may not naturally appeal to you in the beginning. Again, I want to be super clear. I am talking about this conversation from the beginner lens. At the professional lens, you don't get to be a baby and say, oh, I prefer to win a lot, or I don't like losing, and then not do those things. You don't get to do that. At a professional level, you be a fucking professional, you get the fuck over it, and you do what makes sense. But there's something to be said where at the beginner level, to give yourself the best initial chance of getting over those initial hurdles, leaning into your strengths and your natural tendencies will do you well. First lesson, risk to reward, very individualized. You need to figure out where your own balance point is. Another common conversation. You already will know the answer, most people that have been around for a while, but people will say things like, what is the best risk to reward? Everybody that's been around for a while will know the definitive answer to that is there is no best. Doesn't exist. Risk to reward is relative. And there are periods, I find, where certain types of risk to reward concepts make more sense than others. And it's not because some specific type of risk to reward makes more sense than something else, but because of what the underlying strategy is and what you're trying to trade. That might have sounded like a bunch of nothing to somebody new. That's okay. I will explain it. Let's take a look. If we look at GLD, and GLD, well, actually SLV is kind of more interesting because it's had more velocity. So we look at SLV, and as SLV is going up, we make the assessment of, okay, as it goes higher, the probability of it having some sort of pullback gets higher. It can't go to infinity. There will be a natural limit at some point. Where that limit is, nobody knows. So what's happening is each person that's buying this as it's going up is making that kind of decision with risk and reward. They're saying, I'm okay with the risk of this thing going back to X level for the potential reward of it continuing up to Y level. And when that happens in compressed time frames, also with leverage, that's how you find this kind of scenario where over the course of 2 trading days, SLV can drop 31%. It's because there were so many people that are getting into this thing that are trying to get to the risk or the reward side of this equation. But then as people start to sell off, other people are saying, I don't like this risk to reward anymore. I'm getting out. I'm taking my ball and I'm going home. When we look at options trading, the world is a little bit different. And it's because risk to reward is different based on your strategies. And this is the last thing that I want to spend time. This is going to take a little longer to get into. But risk to reward is strategy dependent. This is exactly why getting really good at testing things and back testing things and forward testing things and live testing things is a really important skill to adopt as a trader, especially if you're looking to do this to make a lot of money. That's the ultimate carrot at the end of this, in case you don't remember that. Sometimes it can feel like work for the sake of work. But the whole point of doing this is you can make a lot of money doing this. But because that reward potential is there is a lot of work. Going back to what we were talking about earlier, risk and reward. In markets, the reward is about as high as you can get it. Until you are trading an account that's like tens of millions of dollars where things start to get actually constrained, you can trade millions of dollars. You're still constrained in what you can trade that in, but there's enough stuff that you can trade that in liquidly that it's completely viable. So the opportunity is absolutely profound. The other reward that you get for trading is there is no boss, there is no manager, there is no supplier that you have to speak with, there is no customer that you need to negotiate with, there is no logistical train that you have to navigate. There's none of these natural artifacts of other business delivery mechanisms. Why does that matter? Because that is one of the absolute coolest things about trading. You quite literally are your own boss in entirety. There are just about no other things you can do in life that give you that. If you start a business, you can make way more money starting a really good business than your probabilities of making that kind of money trading, right? Like you billions of dollars can be made. Doing that via trading, super difficult. But you have to have some element of you that wants to build the business and deal with customers. And when Zuckerberg has to go testify in front of Congress, that's part of the shit that he has to do. He's worth billions of dollars. It's worth it to him, obviously. But for somebody like myself, I don't want to do that. Even if I had the choice right now to go do Zuckerberg's job for 5 years and I would get $1 billion, I genuinely would turn it down. I absolutely would turn it down. And the reason for that is because I don't just look at the money side of that. I understand all of the other shit that is going on that I really don't want to do. All of this boils back to the reward side of trading. You can make of it whatever you will. The risk is that the overall skill set that you have to develop is really high. It's very broad. The other element is that there's a lot of shit that you have to learn how to do pretty fucking well. And there really aren't a lot of great resources out there that are comprehensive enough. My guess is you probably haven't had many deep conversations about the individualization of risk reward. Not that it's like profound or anything, but it's just not the sexy part of trading. The sexy part of trading that does well on social media, you guys all know what that looks like. That's how I made $5,000 during my lunch break today, and that's cool. Sure. But unfortunately, that's not the reality of the business. Let's drill this down now out of this nebulous meta level shit, and let's talk about strategy level stuff. The first thing we can do is think about individual trades in the context of they are and evaluate if we like them from a statistical perspective based on the risk and reward. So let's do an example of this. Let's take a look at SLV. SLV has just had a pretty significant drop. It's down here hanging around like the 70 handle. Let's say we think there's a lot of vol in there and we want to sell a put spread. And let's say that we want to center the short around a 30 delta. We think that that's just a better place for us to be, better probability, whatever it is. And we sell the 63. And let's say that we have a small account, so we try to go $1 wide. So here's what we have so far. We have a $1 wide spread. Our premium that we might get for this is, let's call it 35 cents. That means our risk is the residual, 65 cents. What's the probability that our entire thing ends up in the money at expiration? It's 36%. So there's a 36% chance of hitting this. And then again, as before, the residual is our probability of having a winning trade, 64. If we calculate the expected value of this individual position, we find something that's negatively expectant. It's about flat. It's negatively expectant. So what does this tell us? That doesn't mean that you can't make money on this vertical spread. But it means that in order for you to make money, this is kind of like an even shot at making money actually. But you have to have something else going in your favor. Now, let's say that volatility was higher. And let's say that you're able to get filled closer to the midpoint. Let's say that you're able to get in for 40 cents. Well, that changes the profile of this, actually kind of a lot. We go from something that's negatively expectant to now positively expectant. Yet instead of SLV, if we go into something like SPY and we look at a similar scenario, so we short the 30s and we buy the 29 deltas. Notice what you're getting here. Let's say that you get in for 20 cents. What's the probability of us being at or below this 671 handle? The probability of that being in the money is 31.3%. We are deeply negatively expectant. Why? Because the volatility picture in SPY is a lot different than SLV. Does this mean that this position in SPY doesn't make money? No. Certainly could. Absolutely could. But it does mean that you absolutely need to find something else to work in your favor. Otherwise, the risk and the reward is only part of the equation. What I'm showing you here is the missing piece: probability. Once you add a probabilistic assessment to risk and reward, you now have some view into expected value, which is ultimately what matters. Things like probability of profit are fine. It's a data point. But at the end of the day, probability of profit doesn't really fucking matter. What ultimately matters is by far the expected value. How do you get to that? That applies probabilities to the risk to reward profile of whatever the thing is that you're trading. That is going to be strategy specific. There's an example that I use a bunch of times. I'll give you the latest stats for year to date on a strategy that I run. This is a specific long call breakout strategy. Here, the probability of having a winning trade is 48%. The average win is 1102 per contract. The probability of a loss is the residual. And then the average loss is minus 432. Let's take a look at what these numbers shake out to be. Also, I'm going to have to go yell at my dog in a second because he's barking. That's the expected value for this strategy. A lot of people would look at something that has a lower win rate and say that this is bad, or I don't want to do this. However, that doesn't actually matter that much for this specific strategy because of the skew between risk and reward. If I tried to apply this kind of logic to a sell side strategy selling vol and using vertical spreads and SPY, I'll never find anything even remotely close to this. The third and final lesson is that the risk to reward profile is going to vary widely by the strategy that you're trading. So then the next question an enterprising trader should ask is, how do I figure out the risk and reward profile for a strategy? It's a good question. Let's say, again, at the very beginner level, so I'm not going into back testing, forward testing, live testing. I'm not going through all of that. Instead, we paper trade. You can use the base tools available to you and speculate how something does based on your decision making. So what's really, really important if we're going to try to analyze the risk and reward profile of a strategy through paper trading, we need to have a trading plan with a strategy outline that we've thought through some of the things that we're going to do for the individual trade. Why do we need to do that? It's specifically because by doing that, you parameterize things so that you can adjust your management carefully and then observe what impact that has on your total P&L. Give me 1 second. I need to yell at Thor. Or what? I don't even know what you were barking at, bro. But he was barking. Okay. So when I think about building risk and reward and understanding what that looks like, after I have it built in a strategy outline. So let's say, for example, somebody says, well, I want to sell vertical spreads in SPY. And that's how they think that they're going to make their money. Okay, fine. What I would do is come into something like on demand, and I would go back in time. One of the best periods that I can think of to go back in time and to test through would be 2022 and 2023. And it's because you have back-to-back years that look very, very different. It makes it actually really, really convenient to test things across different regimes. And I would go back here to the beginning of the year. I would find whatever the general time of day and stuff that I think I'm going to trade. And I would first build a strategy outline. And again, there's resources on the YouTube channel to, build your own strategy outlines and stuff. But in a strategy outline, there's a couple key sections. There's an executive summary. There's a setup. There's a management. And then there's an AAR section, analysis section, whatever. And then again, sometimes depending on like when I made it and what I was thinking about, there's slight variations. Oh shit. But these are the big ticket items. So what I would do is I would say, okay, so for my short put credit spread strategy in S&P, I think that's a good place to start. What do I think that this thing is going to do and why? First thing, as always, is what's the profit mechanism? It's not just vertical spreads in S&P that's going to make money because I'm selling vertical spreads in S&P. There has to be a specific thing that I think it's doing in order to make that money. And it being a low probability option, that's not a profit mechanism. Options are priced pretty well. So there needs to be something else that I think is there. So for example, maybe as I analyze the relationship in SPY, and I look at the relationship of implied vol versus realized vol, I notice that in general, it's positive. So in general, that tells me that implied vol is being priced a little rich compared to realized vol. So then I say to myself, well, I want to capture that. I want to capture that risk premium. But the issue is a small account won't be able to just sell a straddle, sell a strangle. It's too expensive. So then that's where they might default to selling iron condors or some sort of vertical spread. And if you go through and test this, you might find that as you're selling your iron condors first, that you're actually, when you lose, typically losing on the call side. So then you might say to yourself, well, let me just try the put side and see if that there's enough there for me to capitalize on. And then you might ask yourself, well, shit, why am I typically losing to the upside and the downside tends to be okay? Well, we might find that the premium that you get for the out of the money puts is so much higher than the premium you get for the out of the money calls. So you might find that in general, there's put skew. And that put skew coupled with risk premiums leads to an interesting opportunity to begin exploring. So then we finish codifying all of this random stuff in our strategy outline, and then we begin testing. We go back in time and we say, okay, I'm going to look at something that's closest to like 30 days, provided that it's liquid. These are 5 cents wide. Let me check the next main expiration. These are like 2 cents wide, 2 cents wide. Since I have 2 legs, maybe I'll favor something that's a little wider. You'll have to track the deviation off of whatever you think is optimal. And we come in here and we find our vertical spread. And we're going to get 20 cents, not much. And we take a look at this, and then we write it down in a trade log. Here, come in and you write it down. And then you fast forward time and you do that again and again, tracking what you're doing. This is exactly how you determine and build an understanding of what the risk to reward relationship in something looks like, even if you have absolutely no clue to start. Because by tracking it in some sort of Excel sheet, Google sheet, you'll give yourself something to look back at that's quantified, and then you can use that to make decisions. You can say, okay, on average, I win most of the time. But when I lose, I'm wiping out a decent amount of my winners. So maybe I need to figure out what the conditions look like that I lose in. And that becomes the point where I need to apply some sort of management. I refer to that as cutting the tails, looking for places within the strategy's deployment that have bigger opportunities than others. You have to be very careful not to overfit. But for example, let's say that we run this test. We have our little P&L population plot over here. We'll copy one of these really quick. Just throw it over here for a conversation. And let's pretend that on this very same plot, let's pretend that there are some dots down here. And let's say that there's not many of them. So here we just have 3. But we take a look at these dots and we're like, damn, these dots are kind of big. Like, what the fuck's going on here? What I would want to do is analyze these dots. When did they happen? What was the circumstance around it? And does there happen to be any commonality between all 3 of these that I can capture and then maybe codify so that I decrease my risk to these moves while not negatively impacting my risk to these moves too much? And this is where we get into the world of strategy refinement, slightly different topic. But all of that starts with having an understanding of the risk to reward profile of individual strategies and individual profit mechanisms so that you can make good decisions around them. One final example. And if you have any specific questions on this, now's the perfect time to throw them in. I'll take a look through them before I wrap up. But this is the main last thing that I want to give you guys as an example. If I want to trade earnings and I'm getting more familiar with the earnings profit mechanism, specifically in this case, one being short vol through earnings release. And let's say that I'm paper trading it. I paper trade for 2 quarters of earnings. And I notice that in general, they win. But every once in a while, I have these absolute huge losing trades, 4 standard deviations that are really, really hurtful. And this is in the context of naked short options. That understanding of the risk profile will intimately change the way that I size those trades on average. So let's say, for example, on average, I'm selling a 25 lot. And let's price adjust it to the underlying. So what that means is I'm essentially saying if I trade 100 lots in something that's $20 and I trade 50 lots in something that's a different price and so on, I normalize that. So the lots are price adjusted. And I can use that information to say, okay, if on average, this is how those perform. And on average, over the course of an earnings season, because I did at least 2 of them via paper trading, I know that there's, let's say, 8 of them that become these really big outsized moves. I can now do a better job striking that very delicate balance between putting on enough risk so that I stand to make enough money to make it worth my while, but I'm not putting on so much risk that when I experience the inevitable outsized loss, it doesn't blow me up. Because if I size all of my earnings plays based on those really big, infrequent, outsized losers, then I do even worse. And it's because everything is sized so small all the time that I don't really make any money. Risk and reward. The only way you can make good decisions is if you do the analysis on the strategies that you're trading and understand what they look like, how they behave, so that you can make logical trade decisions. The other piece to that is that so that you can attempt to apply management that improves your P&L, making sure that it's robust, and observing the effects on your risk to reward profile so that, again, you can say, yes, this management approach is helping me, or this management approach is hurting me, even though my average loser has gone up by 40%, meaning I'm losing 40% less, which is great. But my average win has also cratered because I'm being too strict and I'm not getting enough samples on. So even though my average loser has come in, I'm now losing money in the aggregate. That's no good. It's the only way to develop a healthy relationship with risk and reward. So it starts with understanding yourself, your own tendencies. Then you want to start taking a closer look at your individual strategies and developing an understanding of the risk reward relationships in there so that you can make better decisions. All right. I see no questions from me. I got no questions for you. Enjoy your weekend, everybody. Be an outlier. See you guys later.